All right, today we're going to pull back the curtain on those real estate investment deals. You know the ones that promise these incredible returns that almost feel a little bit like magic. So let's dive in and see how the trick is really done.
I mean, have you ever been pitched an investment, right? Maybe in a big apartment building or something, and the numbers just seemed, well, too good to be true? A deal that's promising to make you a whole lot of money, and super fast? Well, here's the secret. It's almost never magic. It's usually a set of pretty clever and, honestly, surprisingly simple number tricks. So today, we're going to become detectives. We're going to uncover exactly how they work one trick at a time.
Okay, our first and I'd argue most powerful trick is what I call the crystal ball trick. It is all about making a very, very optimistic guess about the future. And believe me, this one single guess can change literally everything.
The secret here is a really fancy term called the exit cap rate. Don't worry about the name, okay? All it really means is a guess. It's just the number someone uses to predict what a property is going to be worth 5, maybe 10 years down the road. It is without a doubt the most dangerous variable in the whole plan.
And just look at this. Look at how a tiny little change in that guess has a massive, massive impact. So let's say a property is making $1 million a year. With an optimistic guess of 5.5% exit cap, the property is projected to be worth over $18 million. But with a slightly more realistic guess of 6.0%, that value drops all the way down to $16.66 million.
And there it is. That tiny 0.5% difference in the guess creates a $1.5 million swing in value. And get this, this isn't from improving the building or anything real, it's just from changing one number in a spreadsheet. This single guess can absolutely make or break an entire investment.
You know, this analogy just says it all. Relying on an aggressive guess like that is like planning a road trip and just assuming you'll have a 50-mile-per-hour tailwind pushing you the entire way. Yeah, your arrival time looks fantastic on paper, but if that wind changes, you're going to be very, very late.
All right, let's move on to our next illusion, because this is where it starts to build. I call this one the time machine trick, and it's all about playing with time to make an investment look like it's making money way faster than it really is.
So to get this, we need to know about something called IRR, or internal rate of return. But honestly, the easiest way to think about it is just as a speed score. It's a number that tells you how fast your money is growing. And naturally, a higher speed score looks way more impressive to investors.
So how do you fake a high-speed score? Well, it's a surprisingly simple three-step process. First, the person running the deal buys the property using a temporary loan. Then, they just wait a few months before they even take the investor's money. So, by starting the clock later, the whole deal looks shorter on paper, and that results in a higher, juiced-up speed score. And here's the kicker. This is the most important part of this trick. Your actual profit, the total dollars you get back at the end of the day, doesn't change by a single penny. The property's performance is exactly the same. The only thing that changes is that one magic number, that speed score, on the spreadsheet. It's a pure mathematical illusion. Okay, for our third and final trick, we have the hidden costs trick. Now, this one is less about complex math and more about just, well, conveniently forgetting to plan for some very, very big bills. Think of it this way. You're planning this huge, amazing party. You budget for the decorations, the music, the food, but you forget to put the cost of that giant 5-tier cake in the budget. The party looks a lot cheaper on paper, right? But you are in for a nasty surprise later on.
So what are the forgotten cakes in these real estate deals? Well, it's often three things. First, the big tax bill. You see, after a property is sold, it gets reassessed, and taxes can sometimes literally double overnight, a little detail that gets conveniently left out of the plan. Second is just under-budgeting for repairs. And third is lowballing fees, like promising to manage the property for 3% when the real market rate is actually closer to 5%.
Here's a perfect way to think about this. It's like messing with your treadmill so it shows you're running a 5-minute mile. Yeah, the display looks great, but you aren't actually any faster. Reality always catches up.
So we've seen the crystal ball, the time machine, and the hidden costs. Now for the most important part, how to protect yourself. Let's put together your own investor detective kit so you can spot these tricks out in the real world.
So what are the red flags? When a deal finally comes across your desk, how do you spot these tricks in the wild?
Okay, here's your detective checklist. First, you gotta stress test that crystal ball. Just ask, hey, what happens if the exit cap guess is just 0.5% worse? If a great deal suddenly turns into a bad one, that is a major red flag. Second, look for those hidden costs. Does the tax bill show a realistic jump after the sale? And finally, check the fees. Are they projected way below the known market rate? If so, you should be suspicious.
At the end of the day, you really don't need a PhD in finance to see through these illusions. You just need to know where to look. Great investments, the real ones, are built on real performance, not on mathematical models. So always look for returns that come from the actual real estate, not just from the spreadsheet. That's the one thing no magic trick can ever fake.